Bismillahirrahmanirrahim. In the previous class, we discussed about advantages of audit to sole traders. Then we discussed advantages for partnership, and then advantages of audit for LLCs, limited liability companies. Today we are going to discuss distinction between auditing and accounting. What is the relationship between these two fields? Auditing and accounting are closely connected, but both are separate activities. Keep in mind, both are connected, but these are separate activities. The directors of a company, he's talking about board of directors, he's talking about the management of a company, are responsible for establishing books of accounts. They will make financial statements. They will develop books of accounts that will accurately record financial information. And this is their responsibility to make accurate financial information, to prepare, to record accurate financial information. And that are used for preparing the annual financial statements. And then from this financial record, they will prepare annual financial statements, balance sheet, income statement, cash flow statement, statement of owner's equity. So the management, the board of directors, they are responsible for accurately recording financial information, and then from this information they will prepare the financial statements. It is also the responsibility of directors to adopt consistent and appropriate accounting policies. Keep in mind now, this is also their responsibility that they will adopt accurate accounting policies. Different policies regarding, like, suppose if you are using depreciation method, so which depreciation method and why? Straight line method, declining balance method, double declining balance method, sum of years digit method. So which accounting policy you are following in depreciation? Like different inventory methods like LIFO, FIFO, average inventory method, and you are using that policy. What is the reason for adopting that policy? In order to prepare and present the financial statements. But keep in mind one thing, that if you adopt one accounting policy, you will use it consistently. Not like this, that one year you are following straight line method and the other year you are following the declining balance method and the next year you are following the sum of year digit method. No. When you adopt a policy, so you will use it consistently. This is the responsibility of directors in order to prepare and present the financial statements. The financial statements have to comply with national legislative requirements and international financial reporting standards. And it is also important that they will follow the national legislative requirements inside the country, the laws developed by the government for accounting, and they will also follow international financial reporting standards. Means when they prepare financial statements, they will follow national legislative requirements and international financial reporting standards. Now come to the main difference. Accounting is the process of recording, classifying, summarizing, and reporting the financial information in a logical, systematic manner for the purpose of decision making. In accounting, we are recording entries, then we are classifying entries, then we are summarizing entries. You know about journal, ledger. Recording is done in journal, then classification in ledger, then summarization in financial statements, balance sheet, income statement, and reporting the financial information. and then we are reporting these information. We are making what these information to this information, these financial statements, in a logical and systematic manner. There are methods. You will follow the methods developed by IFRS and GAAP. So you will make your financial statements according to that and systematic manner for the purpose of decision making. And why we are preparing these financial reports? We are presenting it to the top management, and then they are taking decisions about the future. To provide relevant and reliable information, accountants must have a thorough understanding of the principles and rules that provide the basis for preparing the financial statement. If you are an accountant, it is important that you have a thorough understanding, a complete understanding of principles and rules of accounting for preparing the financial statements. Now keep in mind, a simple layman cannot prepare financial statements. For making financial statements, it is important that you have knowledge of these things. You can take the example of a simple shopkeeper. Can he make financial statements? No. In auditing, the concern is with determining whether the presented financial statements properly, that is true and fair, reflect the financial information that occurred during the accounting period. And now the concern of auditor is determining, checking whether the presented financial statements, they show, they reflect, they are true and fair. There is no mistake, there is no fraud, and they are according to the financial reporting standards and generally accepted accounting principles. If you are following any of them, reflect the financial information that occurred during the accounting period. Keep in mind one thing, where the work of accountant is going to finish, the work of auditor is starting from that point. First, accountant will make financial statements, and then when he finished his work at the end of the accounting period, the auditor will come and he will check whether these financial statements show true and fair view, gives true and fair view, and that is that these accounting statements are free from errors and frauds, and they are following the international financial reporting standards, and they are according to GAAP, whatever you are following. If you are following GAAP, so they are according to GAAP, and if you are following IFRS, so they are according to IFRS. Since auditors are primarily concerned with the end result of this work, that is, do the financial statements show a true and fair view? See, I told you, when the work of accountant is going to finish, the work of auditor is starting from that point. So he will check whether the financial statements show a true and fair view. The auditors must have deep knowledge and understanding of accounting, including applicable accounting standard and in practice. Accounting and in practice means he has a deep knowledge and he has experience in these financial statements. The directors will consult with auditors as to appropriate accounting for policies to follow. And then at the end, when the auditor give his opinion, so the directors, he will consult. Consultation means they will take advice from the auditors to follow which accounting policies. Auditors will give a good opinion about these things, to follow which accounting policies, just like I told you, using which depreciation method, using which inventory valuation method, etc. So this is the end of this chapter 1 today. Then we are going to start chapter 2nd. Chapter number 2, it is auditing fundamentals. What are the chapter objectives? Identify types of auditors, and auditors certifications, different certifications for auditor. So what are the objectives? We will discuss about types of audit. We will discuss about auditors and auditors certifications. Understand management assertions and audit objectives. What are audit management assertions? When it will come, then we will discuss about this and the objectives of audit. Discuss audit program and its advantages and disadvantages. What is audit program and what are its advantages and disadvantages? Know about audit notebook and audit working papers. What is audit notebook and what are the auditor's working papers? We'll discuss about these things. Know the owner of audit working paper. Who is the owner of working papers? Auditor's working papers. So we'll also discuss about this. Identify the difference between auditing and accounting. We already discussed about this. So the first thing is types of auditing. There are different types of auditing. Various types of auditing. Audit. Following are various types of audits. The first one is financial statements audit, then there is compliance audit, then the third one is operational audit, statutory audit, annual audit, interim audit, balance sheet audit, cost audit, management audit, and continuous audit. So these are 10 different types of audit. So we will discuss about these one by one. The first one, it is audit of financial statements. In audit of financial statements, what are we doing? We are examining financial statements, determining if they give a true and fair view or they are fairly presented. The financial statements are fairly presented or not. So in financial statements audit, what are we checking? We are checking that it gives a true and fair view and they are fairly presented or not. So what is financial statement audit? A type of audit in which we are checking the financial statements and we are checking that they gives a true and fair view. They are free from errors and frauds and they are presented according to the standards developed by GAAP or International Financial Reporting Standards. So just we are checking this thing that they gives a true and fair view and they are fairly presented. The financial statements are fairly presented. So this is called financial statements audit. The next one is operational audit. A study of a specific unit of an organization for the purpose of measuring its performance. Here, we are checking whether a specific unit of an organization is performing well and keep in mind it can be any unit, it can be any department, it can be, you can say, any department of the organization. We are checking their operations and we are checking, the purpose is measuring its performance. We want to check the performance of an operational unit of an organization. Basically, the operational audit, it is a systematic review of the effectiveness and efficiency of the operations of an organization. We are checking the performance of the operations of an organization. Basically, it is future oriented activity because our purpose is to check the effectiveness and efficiency of organization of the operations of an organization, and on the base of that audit then we are taking some advice from auditors how to make the efficiency and operations of organizations better in the future. Basically, in operational audit, our main source of data is financial data. But basically, here we are checking the operational policies and achievements related to organizational objectives. Keep in mind, we are checking whether the objectives which are set in the start of the year, whether these objectives are achieved or not. So in operational audit, we are checking the operations of the organization. We are checking the effectiveness and efficiency of the operations of the organization, different operations of the organization, and we are checking whether the objectives which are set in the start of the year, whether these objectives are achieved or not. So this is basically operational audit. Compliance audit. Compliance audit. What is compliance basically? Compliance means you're checking whether certain standards which are set, just a minute, some standards which are set by the organization and by the higher authorities, whether the organization is following these standards or not. You know, all organizations, they are following some standards. One standard is standards from the higher authorities, from the government side, from the generally accepted accounting principles, from international financial reporting standards, and the standards set by the top management. So some standards are established, and the purpose of compliance audit is to check whether these standards are followed or not. Just checking this thing, that whether the organization is checking these standards or not. The purpose of compliance audit is checking whether the standards that are set by the higher authorities, these are followed or not. So see, a review of an organization's procedures and financial records performed to determine whether the organization is following specific procedures, rules, or regulations set out by some higher authority. So just like I told you, that here the purpose is to check whether the standards are followed or not. Who is setting the standards? The higher authority. In higher authority, the external authorities and the internal higher authorities. In external higher authority, the government is coming, the financial reporting standards, They set some certain rules and regulations. So if we are checking whether the organization, the auditor is checking whether the organization is following these rules and regulations or not. And also some standards are developed by the top management. So here we are checking whether the standards set by the top management, whether these standards are followed or not. The fourth type of audit, it is called statutory audit. Any audit carried on as per the requirement of law is called as statutory audit. All companies have to get their accounts audited as per the provision of Companies Act of 1956. Now, statutory audit is that audit which is basically a requirement of law. If you are not doing that audit, so you are violating the law. You know about this thing that all companies, this is a requirement for all the companies that they have to get their accounts audited, and this is the provision of the Companies Act of 1956. Now, another thing, in Afghanistan, all businesses, they have to audit their accounts once a year. An auditor from government side, there are no companies in Afghanistan. We're talking about joint stock companies, so don't confuse yourself. Joint stock companies, so there are no joint stock companies in Afghanistan. So there will be no statutory audit. You will be thinking about this thing, that there will be no statutory audit in Afghanistan. No. From the government side, on all businesses, it is a requirement that they will audit their accounts once a year. So this is what? This is statutory audit, you can say. But statutory audit, it is for joint stock companies, that they will audit their accounts once a year. Periodical or annual audit. It is a kind of audit where the auditor verifies the account at the end of the financial year. At the end of the financial year, when the year ends, all the companies, they're auditing their financial data. He starts the audit work after the closure of financial year. When the financial year ends, the auditors, they're coming and they're starting their work. This is a common audit and mostly used by small organizations, and it is used in small organizations. The next one is, so periodical or annual audit is audit at the end of the year. Interim audit. It is an audit conducted in the middle of the accounting year before the accounts are closed. Keep in mind, it is in the annual audit is at the end of the year, but interim audit, it is between the year, in the middle of the year. In other words, any audit conducted between two financial audit is known as interim audit. Suppose this is audit of 2018. One audit. And this is audit in 2019. Here. When 2018 ends, the auditor comes, they audit the accounts. In 2019, when the year ends, auditor comes, he audits the accounts. Now, any audit between these 2 years, any time between these two audits, it is called interim audit. So, any audit between two annual audits. These are two annual audits, annual audit of 2018 and annual audit of 2019. So, any audit between these two annual audits, we call it the interim audit. So he is saying, in other words, any audit conducted between two financial audit is known as interim audit. The objective is to get periodical results to declare interim dividend. Here, the purpose of this audit is whenever company wants to declare dividends, suppose here company wants to declare dividends, so what are they doing? Then they are auditing their accounts. Suppose after 4 months at the end of 2018 audits, now in April or May, the company wants to uh, declare dividend. The company wants to distribute dividend. So auditors will come and they will audit the accounts, and after that, company can announce dividends. And here C, to get periodical results. They want to get periodical results. Suppose after 3 months the company want some results, periodical results, to check the periodical results after 3 months. 3 months, then the next 3 months, then the next 3 months. They want to get some periodical results. So this type of audit is called interim audit. Or after 6 months, the company want to check their performance, whether the objectives are achieved or not. So then here they are checking this thing. So auditor is coming and he is performing an audit. So this is called interim audit. The next one, it is balance sheet audit. It is a kind of partial audit and is concerned with the verification of only those items appearing in the balance sheet. This audit of balance sheet, it is just concerned with the verification of only balance sheet items. In balance sheet, what are coming? Assets are coming, liabilities are coming, and owners equities are coming. So it is more popular in USA. In fact, while verifying balance sheet items, the auditor verifies, checks all related items or accounts. Accounts which are related with balance sheet. They are checking all the assets, they are checking all the liabilities, and they are checking all the owners equity items. So we call it what? Balance sheet audit. So we discussed about different types of audit. The first one was financial statements audit. In financial statement audit, our concern is to see whether the financial statement gives a true and fair view. They are free from errors and frauds, and the financial statements are fairly presented. Means the generally accepted accounting principles are IFRS, these are followed. Operational audit. In operational audit, our main concern is to check the operations of the organization. to check the effectiveness and efficiency of the operations of an organization, and I have told you it is future oriented. The purpose is to identify the weaknesses and then remove these weaknesses for the purpose of making the performance of the operations of the company better and better in the future. So in operational audit, we are checking the operations of the organization. It can be any unit of the organization, or it is checking the whole operations of the organizations, operations of all the organizations. Then compliance audit. In compliance audit, we are just checking whether the standards which are set by the higher authorities, whether these standards are followed or not. Then we discussed about statutory audit, the audit that we are doing as per the requirement of law. Like I told you that all joint stock companies, it is mandatory for them that they will audit their accounts and they will publish their audited financial statements on their websites. So we call it statutory audit. Then there is annual audit. This annual audit, basically it is for small organizations. At the end of year, auditors are coming and they are checking your financial statements, they are checking your financial records, and basically it is for tax purposes. Then interim audit, any audit between two annual audits, we call it interim audit. I told you the purpose is to declare dividend or to get periodical results. We want quarterly results, we want semi-annual results. So for this purpose, we are conducting the interim audit. And I told you about declaration of interim dividend. If the company wants to declare interim dividends, so then what is interim dividend? Basically, this is a type of dividend which is announced. This is basically extra dividend that the company is announcing. Once they announce dividend, but now the performance of the company is good, so now they are announcing extra dividends. And then we discussed about balance sheet audit. In balance sheet audit, the purpose is to check the items of the balance sheet. I think for today it is enough. Inshallah, in the next class, then we will discuss about other things. Have a good time.